Welcome to SoapBox, the group therapy session for the UK advice profession, disguised as a podcast. Together, we chew the cord on the trends, tensions, and total nonsense shaping the business of financial advice today. It's Advisor 3.0 SoapBox edition. I am your host, Abraham Okusoya, here to stir the pot, spark a few debates, and occasionally, very occasionally, eat humble pie. And with me to kick off this glorious mess of a series, first up is the newly anointed Tech Talk Hall of Famer, the master of flat fee financial planning, Matt Pitcher of Alto Wealth. And joining him is the deal maker in chief, the Beyonce of advisor M&A, the woman with a black book so powerful it should come with a GDPR warning. Louis Jeffries of Gunnar & Co. Welcome to the show, guys. Thank you for joining me.
Thanks
for having us. Very exciting.
Guys, the goal here really is to go through some of the latest news and trends, happening in the marketplace. And I thought a good place to start, is an article in the City Wire about a massive decrease. I say massive decrease, but it's only a 3% decrease in the number of clients post-consumer duty. 335 clients advisors have shared, in 2024. So the question is, has consumer duty led to lots of clients becoming unadvised? And this is coming from the latest FCA data, which basically means that firms are disengaging with clients that they are no longer serving. And it begs the question, can or should advisor be trying to serve smaller clients? And if not, who will serve these clients? And just before I cede ground to you guys, there's another story in the FT Advisor about implication for, of this IHT on pensions from 2027 and whether advisors are taking the right approach. So basically you have increase in the number of people or number of planning opportunities for clients. Equally, you also have advisors dropping clients. I would presume some of the, let's call it, lower end of the spectrum in terms of size. So I guess, Louis, do you want to start off? Is this a good thing for the business of financial advice?
Thanks, Abraham. I mean, I think that's a really interesting way to ask a question, because when I was reading these two articles and sort of bringing them together in some way, the FT Advisor talks about the technicality of the role, or the technical level of the role of the financial planner. And then we talk about what you described as that lower end of clients. And then you're asking me a question about the business. And when I think about, how does this come into the business of advice? I think for me, some of it starts with, in terms of orphaning clients, it comes back to a point that I made on your recent podcast about a lot of financial planning business owners are opportunistically owning businesses. They haven't chosen to be business owners. They're not necessarily business people. And so how you build a profitable business across a very broad spectrum of different types of clients, when you're not a business person, is a question mark. And I think that understanding the importance of profit, clearly they understand it because they're getting rid of their clients, perhaps, but actually thinking about how do they build a business that's sustainable and that can grow and that can allow for different sizes and different types of clients. I think that sometimes that's a skill set that's missing in the profession at the moment. And I think that small single advisor firms are, businesses in themselves, that's where you've got this challenge. How do you invest? How do you become a growing firm when, half of or 2,000 authorized entities are single advisor firms. And how are these people going to look after these clients when they don't necessarily have the capabilities or the sort of know-how to run a business that needs to look after clients like this? And who else is going to look after them? Those are some thoughts.
Good point. Matt, should advisor try to service smaller, small?
No, is my essentially unpopular answer to that. I mean, I think I've actually got two essentially unpopular answers for you. You'll be pleased to know. The first is that I think, to your original point, I think actually probably Consumer Duty has driven some advisors to rationalise the clients they're looking after, to disengage a lot of clients that are unprofitable because all of a sudden they're being forced to by the regulator. My first controversial point is that actually I think the regulator's doing a really good job in this area. A lot of advisors, I've seen a lot of commentary from advisors saying that actually this shows that Consumer Duty is a bad thing, or that it's not working, or there's additional burden. I see it completely 180 degrees the opposite direction. I think the FCA was looking for better outcomes for clients, better ongoing services. They've pushed that, they've forced it, and inevitably, therefore, there was always going to be some clients that weren't being properly looked after that should now be disengaged. We can come on to how they get advice in the future in a minute. So I think actually Consumer Duty's done what it should have done. I don't think most advice firms are set up. Frankly, you service smaller clients. There are firms local to our office here who will onboard a client, or certainly used to onboard a client, whether they came to them with £4 million portfolio or a £20,000 ISA, because they wanted to feel like they were helping everyone. They wanted to give everyone access to advice. But the difference in revenue from those two clients, one's paying as tiered percentage fees, one's paying £200 a year, one's paying £30,000 a year. Even if one is getting a meeting every single month and one is only getting a meeting every year, and I suspect they weren't even getting that, to be honest, that the £20,000 ISA client is not getting a good service, and frankly, the advisors are losing money on them by the time you take into account all the costs of servicing that client. So I think all advisors to operate on the traditional model that most of us do, where it's client contact, whether it's face-to-face or it's Teams or Zoom or whatever, need to start getting a bit more sensible about profitability, need to serve the people that they're set up to serve.
So this is interesting. Louis, I would take issues with your characterization of this as a small solo advice problem. I don't think it is. Now, the data doesn't tell us, but my instinct is that actually this is likely to be a problem with larger firms. And I say that because this is coming, I would suspect, essentially off the back of all of the noise that the FCA has been making around clients who are paying fees but not being serviced. So I would say, maybe I am generalizing, but a lot of the smaller firms would have known anyway that they can't afford to service smaller clients, and so they would have maybe disengaged with those clients. Whereas in larger firms, especially where there might be consolidation happening, book of business has been acquired and no proper segmentation has been done, clients are still paying. I mean, to the point, we've seen some of the larger firms making allocation to compensate these clients in their financials. And so I would challenge that this is a small advice firm issue. I think it's more likely to be prevalent in large firms. Throw daggers at me.
No, you know what? I think yes and no. I think yes, 100%. If you look at it from a volume perspective, if you look at, as you said, polluter pays, you look at all of the press around, we know the companies that were listed, that were putting money aside. So I think 100%, I completely agree. If you actually look at the volume of people that are affected, I think you're right there. But I still think, and Matt said it himself, that there is a culture, not in all, but in many small owner-managed firms, which is a culture of helping people. It's my job to help people. And I have spoken to so many financial planners who, first off, helping people means not charging too much. So we must charge 50 basis points, often not more, not 60 basis points, certainly not 80, 100 basis points. 50 basis points. Otherwise, that's not fair. We're not helping people. And secondly, to that point of saying yes to everyone. And I have seen so many, and it's way less volume, unquestionably, but here I'm talking about culture. I've seen so many firms where that intention, that good intention of the manager unfortunately has those negative impacts of they don't make enough money to hire enough people to look after the clients. The clients, they can't say no because they don't want to stop helping people, and everybody just ends up in this limbo. And in that sense, obviously, Consumer Duty has really helped to sort of sweep that out. But the sad thing is, I think about those smaller businesses is that they haven't found a way to help the people that they want to help. And some of that, I think, comes into the focus of being business people and charging more and understanding the profitability point at which you can service a client, and working with your whole operational structure to be able to do it. It feels a bit black and white. We don't want to charge anymore, but therefore we're just going to have to orphan them off because Consumer Duty says we have to do this. It feels like there's no middle ground.
Is it not black and white? Matt, essentially, we're saying advice is a luxury item. We're business people. Unfortunately, if you can't afford it, or if our fees are going to get to levels where it becomes not a good value for you, we're just not going to do it. I mean,
yeah, no, I think you're right. I think and financial advice in the way it's currently delivered, right? So that's what we're talking about. The environment we're operating in at the moment, most of us, is a luxury item. There's a lot of noise about the advice gap, and
well, yeah. Why do we talk about that?
That's necessarily the job of most financial advisors to plug that gap. It is a luxury item because it is time with an individual in a coaching relationship, or even if it's tax planning, whatever it is, and to be worth being paid the kind of sum of money we are paid per client, there's got to be enough value add. And there is a whole segment of the market where the advice gap exists, where those clients don't have sufficient complexity for an advisor to make a meaningful difference. But whatever the various surveys from some of the big investment managers tell you about advisor alpha, the smaller the client, the simpler the need, the less we can do to deliver that added value. Now there probably is a version of financial advice that doesn't involve maybe financial planners, fellows of the various institutes to be directly dealing with clients. I'm sure there is a solution that fits in that space, but it isn't the traditional advice model that fits in that space.
Yeah, and I don't know if people in the legal profession or other professions are having conversations with themselves about having a legal advice gap or whatever. We're professionals, we're here to do a job, we would do it for clients who can pay. Willingness and ability to pay is important. And like all these people, I read all these things, I get where they're coming from. All these people on social media and industry press who say there's an advice gap that an advisor should fill. The regulator should do something about the advice gap if they care so much. There are fintechs actually trying to do things about advice gap using AI. I've had several conversations with fintechs who are maybe wanting to use AI to solve the advice gap somehow in some shape or form. What I do not believe is that any amount of technology or any relaxation of professional advice regulation is going to result in qualified professionals spending time on, for lack of a better word, lower value clients. I just don't see a world that you can make that work, is my thought.
I just think that's such I'm not a financial planner, that. And I work with
It's often people who are not financial planners who think financial planners should.
And well, this is my question, right? Because I feel like when I read stuff in FT Advisor, I hosted a roundtable of 20 big buyers in September with FT Advisor. And one of the opening comments was about the advice gap. I mean, should we even be putting the luxury financial planning service proposition, which we've described today, which I love the thinking of that. Should we even be putting these two things together, advice gap and this? Now, when you say it like this, it doesn't make sense. But I, as somebody who goes to a lot of industry events, it seems that they are being put together.
Yeah.
And it is being thrown at the door of the financial planning
the
profession.
day I am king. All right. Thank you, guys, for your thoughts. I want to move on, to a related topic to this, which is the newly published retail intermediary market data. Essentially, the I have been looking forward to this. They normally publish it in the summer, and every month, I go in to see whether the FCA has published it. They finally got pull their fingers out of wherever it was, and they've now published the latest version of this data, which basically showed that the total number of advice firms, so these are regulated firms, declined by about 10% in 2024, and the total number of RIs have also declined by about 8% in 2024. Just for context, the highest number of segment where you see a drop in number of firms are actually firms between 6 to 50 advisors, where you've seen about 15% decline in the number of those firms. And the same goes for where you've seen the RIs, the number of registered advisors, decline. It's been more in that middle category. And, is this a worrying trend? If you look longer, if you just zone out a little bit, the number of firms have declined, total number of firms have declined by about 20% in the last 5 years. The number of advisors have declined by about 7% in the last 5 years. Is this a worrying trend for the business of financial advice? Matt, your take.
So reduction in number of advisors that I would find worrying. We know that we haven't got enough financial advisors. I mean, I've been doing this 25 years, and probably every year for 25 years, we've been told that the average age of an advisor is just getting more and more, and we're suddenly going to see a load of retirements and no replacement. I mean, maybe actually we are finally seeing it. Just a quarter of a century for it to happen. I don't know. We do need more advisors. We definitely need more advisors coming into the profession. It's a good profession. It pays well. It is amazing to me that there aren't more, particularly given the lack of grad jobs over this summer, going into some of the big accountancy firms as an example. It amazes me that there aren't more candidates coming in. I don't know if that's our fault as business owners. We've got 3 trainee advisors ourselves, or whether the candidates are just not coming through. I'm not sure. In terms of the number of firms, that worries me less, to be honest. If you're in that mid tier, you've probably built something that you want to sell to someone. I'm guessing. I think a lot of the smaller one-man shows are probably very content to just run as they are a lifestyle business and come up with some kind of exit down the road. Those mid-tier firms are probably more interesting from a consolidator's point of view. From an acquisition point of view, Louise would know this much better than I would. So I'm less worried about firms getting chewed up in the process. I mean, that's just the machine of capitalism, right? The number of advisors, I think, is more of an issue.
Louise, I lay all of this blame firmly at your door.
I wish I did it all.
Are you worried you might run out of firms to sell anytime soon?
Oh my goodness, ask me after the weekend when I've had a rest. I want to start with Matt's point about advisors, and I want to come back to this point around this luxury service, and also something that you and I talked about on our podcast about this deep and meaningful relationship that the advisor and the client have, and Matt called it a coaching relationship, and of course that costs a lot of money. And I just wonder in the future if that's truly what people are going to want. So thinking about how much resource do you need? If I just say from an economic perspective, of course, we don't want a shrinking profession or a shrinking industry. But if we think about how do people want to interact in the future, if we think about their needs, so the baby boomers, come on, we know that the baby boomers who are supporting this profession at the moment are very wealthy, are proportionately significantly more wealthy than the next generation along. I mean, is there a risk that we pump out a load of new financial planners that in 15 years' time don't have any clients to look after anyway? Or we don't need that volume because the clients that they do look after don't want this cuddly, deep and meaningful, come to my house and have a biscuit relationship. they want something different. And I think for me, I think this is the really interesting thing about the future of the profession, the future of the service proposition, is really looking at those demographic bubbles, looking at the volume of people that are going to, the actual quantum of people coming into retirement versus the baby boomer quantums, and then looking at what service they want. And I think because all of that is different, I don't think we can make assumptions or I don't think we have all of the data to know whether or not this is a good number of advisors coming through or not.
I guess the point on that is that money will go somewhere, right?
Yeah.
I mean, if HMRC have, or the Chancellor has anything to do about it, quite a chunk of it will go to them. But that money is going to flow down. We know it's not going to flow down equally. So the inequality, financial inequality in our society has expanded massively over the last 25 years. We know that's only projected to get worse because there are the small number of baby boomers holding a lot of wealth who are passing it down to a smaller number of beneficiaries ultimately. So I take your point about what the relationship of that next generation, how they want that relationship to be conducted, whether that is different. But I still think that they do want, if they're very wealthy and they've got a lot of complexity, they do want some hand-holding. Whether that's a cup of tea and a biscuit in the house, probably not. These are busy people. They're much more used to being on phones, being online. So that the delivery mechanism maybe has evolved, definitely. But I think they still want a human at the moment to manage that. I mean, frankly, then when it passes down to who knows at that point when the Gen Z is going to be inheriting sort of the second time. Who knows at that point? I think for now,
who knows how much money will be left?
Yeah,
I agree, but I still think there are huge efficiencies with a different service proposition or a different service methodology that come into play in terms of resourcing and the level of people that you need in reality.
Do you see a world of GP service for financial planners? I can't see this world where someone comes in, they spend 20 minutes with a financial planner, you look at data about them, you can see data about them, their money, where things are, and you can give them a prescription to go. I just don't see that kind of light touch service working for financial advice. Do you?
I mean, maybe as I was going to say as a younger person, but we're all quite young here. I think a starting point is, so if you get a cough, you go to the doctor because you know you've got a cough. Why do I know I need financial advice or financial planning? Even if I inherit, and obviously the issue is it's an age thing, isn't it? Because if I inherit any money right now, I've got debts coming out my ears. So clearly, none of that's going to a financial advisor. So, but I think it's sort of understanding why you needed financial advice in the first place, because if there isn't that education across the market of the role that it can play, then you're never going to go and self-serve it or go and search for it yourself. Somebody, you talk to someone, and I think this supports the referral story, because somebody talks to someone and they say they've got this person who's helping them and they're doing this, and then you go, oh, okay, right, well, maybe I'll meet that person. I'm not convinced, at least in a more mass market, that people always know what the role is.
Yeah, so I agree. If we're talking mass market, absolutely. If it is a higher net worth market of younger people, and you look at what they're spending their disposable income on, or any capital they do receive from the generation above them, they will have private trainers, they'll have physios, there'll be therapy. True. All these people they'll be engaging with on a one-to-one basis who are expensive luxury. If their taxpayers are complex enough, they'll have an accountant. So you slot as a professional quite nicely into that stack. Again, we are talking about the top 1% by wealth, inevitably. So this isn't mass market. But again, I don't think most financial advice firms, even the big firms, are well set up to cater for the mass market. I think, back to Abraham's earlier point, I think actually you probably need some kind of technology-enabled service. I mean, interestingly, you can't get into my local GP surgery, unless your legs hanging off by a thread. For where we live, in our little part of North Hampshire, actually you need to jump on an app on the phone. GP will be, I don't know, we're somewhere in the UK, and you pay £90 and you have your consultation over the phone. It's a different delivery method. It's the only way it's being fixed where we are, and it may be that there's some kind of finance coaching, I don't know, some kind of GP service, but it would have to be delivered that way. It's got to be something that's scalable if it's for the mass market.
All right, enough enough of doom and gloom. There are some positive data points in the FCA data. Essentially, across board, you see an increase in the advisor revenue. So total revenue per advisor for solo firm has increased in the last year to 24 by about 4%, 3.4 actually. It's 5% for the 2 to 5 advisor category and 3% for the 6 to 50 category. For the over 50 advisor category, not so much. Actually, decline, and this is before real time, before you apply inflation and before you extract investment return, of minus 1%, I decrease actually. And when you look at profitability, I always find profitability of solo advisor firms a little bit not the accurate picture, because you need to extract the dividends out of the picture. But there's a slight increase in profit across all of those firms, apart from the over 50 advisor firm. Just one point on that is there are only, as of 2024, there are only 45 firms with more than 50 RIs. That includes network, and only 25 of them, so about 60% of them, are profit making. A significant chunk of them, so about 40% or so of the larger firms, are actually losing money. You might say that's because they're reinvesting in buying firms and acquisition. Depends on where you put that on the balance sheet. But is there anything to dread or anything to celebrate in that picture? Louise?
So you're saying this is not including any increase in investment values that are driving increased revenue. You're saying that
No, yeah. So this, of course, this includes the data you're looking at includes investment returns.
Yeah.
And so if you extract investment return from the growth across body, will probably be a net reduction in revenue.
Yeah, I think in the owner managed space, which are those smaller ones, I think it's been a good year, hasn't it? To the point that more people need advice. Rachel Reeves has brought, just talk about the IHT piece. More people have been driven to need that complex advice. Plus, as far as I'm aware, as a layperson, the markets have been pretty favourable over the last 12 months.
Yeah.
And so I would have thought it's been a pretty good year for most financial planners. And my experience of doing this for 12 years, and we often know people for 10 years before they sell their business, those businesses, they do really well over those periods. They think, oh, shall I sell it now? And we talk about how much it's going to be worth, and we wait a good few years. And invariably over the last 12 years, there are many factors that will continue to help those businesses to grow. Market of this point, reduction of businesses, of service opportunities, i.e. you're losing firms. So there's always lots of good drivers for growth, and that's why it is a great profession.
Matt?
Yeah, I'd say,
does this strike you? Does this strike you as?
No, I don't agree with Louise. No, it doesn't strike me as good. I mean, given the following wind of a reduction in advisor numbers and the incredible market returns we've had, and the fact that most firms' revenues tied to percentages and therefore percentage of assets, those numbers should be extraordinary in terms of an explosion in
much higher.
Yeah,
it really should. And so it puzzles me that it isn't. It looks a bit anemic to me. I mean, maybe I'm missing something, but I would expect much bigger numbers given everything else. I mean, if you take reduction numbers of RI, I mean, maybe there's a lag in data there, plus market returns. If you add one in, strip the other out, you're probably negative revenue per advisor compared to the prior period, which seems extraordinary to me.
And if as for you as a financial planner, if you then adjust for risk ratings and you look at the sort of returns that you've seen on your portfolios for more moderate risk clients, which I'm guessing is a bit of an 80-20 rule in terms of the proportion of clients who sit in those categories. If you had a lot of clients in that category, would they also be supporting a story where actually the revenue growth should have been that much higher?
Absolutely. I mean, sorry to jump in. I'm just looking here, if you take tracker 50, which is like, 50% equity, 50% bond, global equity, there's no active or anything. In 2024, tracker 50 is done 10.7%. Okay, net off 1% of advisor and platform fee out of that, you still are in north of 9% of net return in 2024. If you then contrast that to the average advisor revenue increase that year, revenue per advisor increase in that year of about 4% across board, that's not good. What is happening? Is it two things? I don't know. Maybe there is shedding of clients going on. Market's gone up by about 8%, 9% net of fees for a balanced portfolio, but still you have revenue growth of 4%.
Money out?
And maybe it is because it's growth.
Maybe money out.
But it wouldn't be that, sorry, but it wouldn't be that much, would
revenue
it?
there. So maybe it is disengagement with some clients, might be some of the answer to that. So if you've disengaged because of consumer duty, back to our item at the top. But I mean, you still can't make the numbers add up. And really, you'd expect those kind of numbers in an environment where the profession was going through a big recruitment drive and bringing in loads of new advisors, because that obviously averages down your revenue per advisor. So
but that's not happening.
No, but I suppose there is that lag, as you said, about if you're bringing new clients on, you're not going to get a full year impact on your revenue for new clients.
True. I mean, this is where Abraham keeps promising us, Louise, that tech is going to solve all of our problems and enable us to scale our businesses. And I'm sure he's right. I'm looking forward to the day where we get these numbers, and because of efficiencies driven by software and AI in our businesses, the client numbers per advisor and therefore revenue per advisor just explodes off the chart, because we're able to serve more people with the same number of advisors. That's the dream.
No, I'm afraid actually I don't see that world. Certainly for the average advisor, it's a really big indictment of this technology, the idea of technology improving efficiencies and all that stuff. And because here we're looking at the median the median advisor, let's say, or in this case, it's actually the mean advisor, so it will be great actually if you can segment this client and this data and look at, say, top 10%, or look at advisors in decile, because what this tells me, I'm afraid, is that the top 10, 20% of advisors are actually doing great. They're doing probably north of £400,000 a year. It will be interesting to see whether there's been significant, meaningful increases in their productivity. I doubt, but they're certainly doing better. Whereas, anything below sort of the median, maybe you actually have a real reduction in revenue. And when you look at the average, it's this bad. But I absolutely agree with you. It's an indictment on technology improving efficiency. It is an indictment on I don't know. It's not such a positive picture, I'm afraid. I was looking for something positive in all of this, but it's not. And that might suggest there is more to sell.
Yeah, look, I mean, if you want the positivity, what does it tell you? It tells you there's a massive opportunity out there, right? If you're a good advice firm, if you know your onions, if you've nailed your process, your software, you've got a compelling client proposition. I mean, my goodness, what a time to be in business, right? Because you've got reducing numbers of advisors, you've clearly got average advisors who just aren't coping, aren't increasing revenue per advisor. I mean, what there is to go at is extraordinary.
What's your experience of the younger generations coming up? And by that I mean more sort of in their 30s, and how the clients are sort of reacting to those younger people as that trusted advisor, that coach that they're paying, their luxury product? Are you finding that clients are quite comfortable with much younger advisors?
Well, that's a really good question. So it depends how they're positioned. So in our business, I would always position my guys who are all in their sort of late 20s to mid 30s, having more energy than me, being more up to date on the tax and the technical, just having the appetite and the ambition. And actually, when you start talking in those kind of terms with clients, we do a lot of sort of joint client working, so I get to see how they're interacting. And I think the majority of the advice, it was very kind of you to say earlier, Louise, that we're all young. I'm not sure I fit into that category, to be honest. But I think I hear from a lot of my peer group that, it's all about the wisdom and the years, everything else. And that's what clients are attracted to. I'm not sure that's true. I think that's probably what they're telling their clients and what they're telling themselves. There is a point at which your trainee advisors should shoot past you in terms of their ability. And that's fine. And I'm very low ego on this. I'm very happy to big up the guys who are taking on clients as being better, particularly as my role shrinks and it's less client facing.
You've done some good work on this. You've brought in, as just off the top of my head, probably 3 advisors in the last 2 years under the age of 35, below. So you're bringing that next generation. I see, younger advisors coming into the mix, but we're hemorrhaging so much on the other side as the whole sort of industry, the wider industry or profession, if you can call it that, is hemorrhaging so much. We're losing, roughly speaking, I was looking at the data. I think it will work out to be about 400, 500 advisors year net, which you say is not, you think it's not bad, but against a backdrop of 25,000, is meaningful. Net, we're still losing 400, 500 advisors a year.
So I mean, the positive is all of our guys are career changers, right? So we've got one who's come from NHS, one who's come from accountancy. They've all done 5 to 10 years in a different environment. Okay, it's hard work when they come in as trainee advisors, but my goodness, I mean, they're excited to come in to this profession compared to the profession they've been in. It's a marked difference for them. So they're super excited, wanting to get stuck in, wanting to learn. And it's energizing for the business and the culture of the business as well. And being career changers, they don't have any bad habits. So they've not learned.
But they're bringing all that life experience. Can I just ask one question on this, or are we time-wise?
Please go on.
I'm just interested in also in this future, if we can get a future where we do bring more into the profession around the role of employed roles versus self-employed roles, and coming back to some of your questions sometimes, Abraham, about diversity and independence of lots of smaller businesses versus the large scale opportunities of employed roles in larger organizations. And what do you guys think is the right mix, or what is important? Should there be more employed roles because you've got some guaranteed salary, but you're not building anything for the future, which is what we've seen a generation of financial planners do? What are your thoughts,
Matt?
Yeah, so look, I think it depends on the person. All of our guys are employed. That suits them. That's what their stages of life. That's what they're looking for. They're not looking to build something they can of their own by themselves. If they want to build a stake, they can do that. Absolutely. So there's that opportunity. But where they're at, they want to be paid well and being in a solid environment where their remuneration is not dictated by their going out selling and their behaviors, right? I do think it's because I do a lot of mentoring of younger people coming into the industry through our professional bodies, and there is a certain type who are entrepreneurial from day one. So they've got the energy, they've got the vision, they've got fire in their bellies. They want to build something, and they're super clear about what that thing looks like, and they're risk takers. But that's probably not the majority, to be honest, of people that want to come in and be advisors. For those people, great, they can go to Plan X or Verve or whatever, some of these startup modules that will launch them into being their own thing. But that's quite rare to have that early on in your career. So I think if you're coming in, just most people want that solid structured career path than definitely an employed role.
Yeah, I agree. I think most people, overwhelming majority of people who come into the profession and for the first time will come into employed roles. The self-employed role for new entrants into the profession is a brutal journey, frankly, that I will not wish on my worst enemies. So I think, entering into the profession will be employed roles. What I do see, and I'm seeing more and more of, are what I call experienced but discontent advisors who are often in larger firms, sometimes, not always, but often in consolidated firms who do not want this kind of, the direction of travel that the firm might be going, and want to strike out on their own. So they become breakaway advisors. And I was doing some number with an advisor recently who basically said, I've been in this firm for so long. They work out the number of advisors, a number of clients who will go with them, follow them. And we said, well, at 85 basis point of advice fee, you will not only reduce overall cost for the client, but also you will be earning more money than you earn at your current firm. Of course, you have other headaches. And it seems eminently doable. And I said to them, check your non-compete. So I see more and more of those type of breakouts, but that's not a path for the new entrants into the profession. No, it's not. Anyway, I think that's the note on which we're going to end today's soapbox. I hope, guys, that you've enjoyed the conversation. I've certainly enjoyed it. So a big, massive thanks to my guests, Louis Jeffries of Gunner & Co. and Matt Peacher of Alto Wealth. Thank you very much, guys, for your time, for your wisdom, and see you next time.
Thank you, Abraham.
Thanks for having us.